Hey everyone, welcome back to Stock Predictor, your home for smart investing, powerful market insights, and no-nonsense analysis. Today, we're diving into one of the most important updates of the year. The market just started its next big move. Whether you're a long-term investor, a swing trader, or someone watching from the sidelines, this moment could define how you position yourself for the months ahead. So, make sure you watch until the end, because I'll break down what's happening, why it's happening now, and how you can prepare for the opportunities and risks that are emerging. Now, let's get straight into it. For the past several months, the market has been stuck in a range, bouncing between highs and lows, confusing traders and leaving investors unsure whether to go all in or pull back. But something's changed recently. We've seen key technical levels breaking, major institutions repositioning, and economic data starting to shift in a way that suggests the next big move has officially begun. If you've been following the charts, you might have noticed how volatility dropped sharply just before this move started. That's often a sign of calm before the storm, and now that calm is over. The S&P 500 is showing clear breakout patterns, the Nasdaq has regained momentum, and even the Dow Jones, which has been lagging, is starting to catch up. This synchronization across indices isn't random, it's a signal of a broader directional shift. So what's driving this new wave? It comes down to three main forces: the Fed's policy pivot, corporate earnings resilience, and the renewed appetite for risk across global markets. Let's unpack each one. First, the Fed. For months, markets have been trying to guess when the Federal Reserve will finally pivot away from aggressive rate hikes. Inflation data is cooling, consumer spending is steady but slowing, and job growth is normalizing. That combination gives the Fed cover to start signaling a more dovish tone. And as history shows, whenever the Fed eases off the brakes, markets tend to accelerate. Second, earnings. Despite all the talk of a recession, companies have delivered stronger than expected profits. Big tech, energy, and even industrials have surprised analysts. Many firms cut costs aggressively in 2023 and early 2024, so they're now leaner, more efficient, and better prepared for growth. That's why investors are rewarding them, not for what's happening today, but for what's coming next. And third, global risk appetite. When global money starts flowing into equities, it's often a reflection of optimism. We're seeing that again. International funds are pouring back into U.S. markets, retail investors are re-engaging, and institutional traders are building long positions. That collective movement is what fuels big directional shifts, the type we're witnessing right now. Now, some of you might be wondering, does this mean we're heading into a full-blown bull market? Not necessarily, but it does mean we're entering a major transition phase. Markets don't move in straight lines. They evolve in cycles: accumulation, expansion, distribution, and contraction. What we're seeing now looks like the early stages of a new expansion phase. If you zoom out and look at the bigger picture, you'll notice how similar this setup looks to previous turning points. Think of 2016 after the correction, or 2020 after the pandemic crash, both moments where investors were skeptical, yet markets were quietly preparing for massive rallies. It's often when most people are uncertain that the biggest opportunities emerge. Let's talk technicals. The S&P 500 has broken above its 200-day moving average with strong volume. That's not just noise, that's conviction. The Nasdaq's tech-heavy index is showing higher highs and higher lows, a classic sign of trend reversal. Meanwhile, the VIX, the fear index, remains relatively low, signaling that investors are cautiously optimistic. When technicals, sentiment, and macro factors align, that's when big moves happen. But, let's be clear, this isn't a call to blindly jump in. Smart investing means understanding both sides of the story. So, let's also look at the risks that could derail this momentum. Inflation, while cooling, is still above target. If it flares back up, the Fed might hold rates higher for longer. Geopolitical tensions, energy prices, and election year uncertainty could also inject volatility back into the system. Still, the market doesn't wait for perfect conditions. It anticipates. And right now, it's anticipating that the worst of the tightening cycle is behind us and the next growth wave is starting. Let's talk sectors, because this next big move won't lift all boats equally. Technology is once again leading the charge. AI-related companies, semiconductor makers, and cloud infrastructure firms are seeing strong inflows. Energy is rebounding as global demand picks up and supply remains constrained. Financials, after months of underperformance, are starting to show strength as bond yields stabilize. Even defensive plays like healthcare and utilities are catching a bid as investors look for balance. The rotation we're seeing right now is powerful. Money is moving from lagging sectors into leaders, from safety into growth, and from uncertainty into conviction. That's classic behavior at the start of a new trend. If you're wondering how to position yourself, here's what I'd focus on. First, identify companies with strong balance sheets, consistent cash flow, and pricing power. These are the firms that not only survive volatility but thrive during transitions. Second, keep an eye on leadership. Follow where institutional money is going, not retail hype. Third, use technical levels as your roadmap. Breakouts above resistance or successful retests of support often signal continuation. Now, one of the most fascinating parts of this current setup is sentiment. Retail participation dropped significantly during the past year's choppy sessions, and that's usually a good contrarian indicator. When retail steps away, institutions quietly accumulate. Then, when the breakout becomes obvious, the retail crowd jumps back in, driving the second wave of momentum. That's exactly what seems to be unfolding right now. Another important point: liquidity. Markets move when liquidity flows. With the Fed likely slowing its tightening, and global central banks easing their policies, liquidity is improving. Combine that with buybacks, which are ramping up again, and you have a recipe for higher prices. Now, let's talk psychology. Market transitions often start when fear and fatigue dominate investor sentiment. People give up on predicting, they get tired of sideways moves, and just when they stop paying attention, the next leg begins. This is why patience and preparation are key. If you've been disciplined, stayed invested, or kept your watchlist ready, this is your moment to act strategically. But again, not emotionally. You don't have to chase every breakout. Instead, think in stages. First, identify sectors confirming strength, like tech, energy, and select financials. Second, track pullbacks. Every rally has corrections. Those dips are often your best entry points. And third, always use risk management. Stops, diversification, and time horizon. These protect you from volatility even during bull phases. Now, let's zoom out and ask the big question: how long could this move last? Historically, after major consolidation phases, the next leg up can last anywhere from 6 months to 2 years depending on macro factors. Given that we're transitioning from a tightening cycle to a potential easing phase, this could easily extend into mid or late 2026. But keep your eyes on earnings. Because while Fed policy sets the tone, earnings drive direction. If corporate profits continue to grow and guidance remains positive, this rally has real legs. On the other hand, if we see downward revisions or margin compression, the market could pause. One key chart that's getting attention right now is the yield curve, which has been inverted but is now starting to flatten. Historically, a steepening yield curve after inversion has been a leading indicator of market expansion. That, combined with the Fed's potential shift, is why so many analysts believe this is the start of something bigger. Also, don't underestimate retail momentum. Platforms like Reddit's Wall Street Bets and X, formerly Twitter, investing communities are buzzing again, but this time the tone is more mature. There's less gambling, more strategy, and that's a good sign. Retail traders have learned from past cycles, and they're coming back smarter. So, where could we see the biggest moves? Watch innovation sectors: artificial intelligence, renewable energy, fintech, cybersecurity, and biotech. These are areas where long-term growth themes meet renewed market optimism. Also, small caps could finally have their moment. After lagging large caps for years, they're showing early signs of rotation. This market move isn't just about short-term trading. It's about recognizing the start of a structural shift, from defensive positioning to growth orientation. The investors who spot it early, stay disciplined, and manage risk, they're the ones who benefit the most. Now, if you've been hesitant or sitting in cash waiting for clarity, remember, the market never gives perfect clarity. The next big move always feels uncertain at the start. But the key is to have a plan, understand your risk tolerance, set your goals, and execute gradually. You don't have to time the bottom or the top. You just need to participate smartly in the middle. In short, here's what's happening. The market has woken up, the trend is shifting, and the next major move is underway. Whether it's a bull run or a prolonged upward rotation, one thing's clear: sitting out could mean missing out. So, take a deep breath, review your portfolio, and prepare your strategy. Don't let short-term noise distract you from the long-term opportunity. This is the moment when investors are made, not by luck, but by discipline and vision. And as always, remember, markets reward patience, not panic. Whether you're trading short-term or investing long-term, focus on process, not emotion. Because the big money moves happen quietly, and right now, they've already started. If you found this video helpful, make sure to hit that like button, subscribe to Stock Predictor, and turn on notifications so you don't miss my upcoming breakdowns on the sectors and stocks leading this next phase. Drop a comment below. What's your outlook for the market right now? Are you positioning for growth or staying defensive? I'd love to hear your thoughts. Thanks for watching. This is Stock Predictor, and I'll see you in the next video, where we'll break down exactly which sectors could lead this next big market move, and how you can ride the wave without getting caught in the noise. Stay smart, stay strategic, and remember, the next big move has just begun.